You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
Welcome back, everyone. Welcome back, Brandon. How's it going?
Hey, what's going on? How you been?
Yeah, good. Not a lot. I'm very happy to see, I checked out the comments on the last podcast and we got some feedback on our Japanese pronunciation of those 5 companies. So I thought we could start with that. So
okay,
we got 2 bits of feedback. One is much better than the other, but the first one was
give me the good news.
So the good news. We'll start with the good one. I got an 8 out of 10, and you got a 9 out of 10.
Come on, get around us. That's awesome.
Yeah, this person says, "Sorry, Hamish, Brandon won." So
gotcha.
Unfortunately, I've been I've lost that one just by a little bit, but that was a lot more. That bit of
Arigato gozaimasu.
Wait, what?
I don't know.
Turns out Brandon just speaks Japanese.
That means. Sorry.
Turns out you just speak Japanese.
I just speak. No, I don't know. I think I did it in I did Japanese in year 2. I think. I can't even remember what arigato gozaimasu means.
Anyway,
I can't even. I'm trying to remember other phrases, but I'm just drawing blanks. Sorry. So that was the good news.
Yeah,
sucker.
The bad feedback was someone else said we were a 4 out of 10. So
a 4 out of 10. That's a lot different to 9 out of 10.
Yeah, it's a bit stiff. We've got a bit of divergence between our results here, so not really sure which one's more accurate, but. Probably the 4 out of 10, let's be honest.
I was just going to go with the 9 out of 10. I'm taking that.
Pat yourself on the back.
4 out of 10, I'm throwing that away. I'm not listening to that.
Oh, dear. No, I'm terrible with other languages. I learned, obviously, in high school, I did a little bit of Italian and then a little bit of Chinese, but I can't remember much of either of them, really.
J'adore le boulanger. I think that means I love the baker in French, which was probably accurate. I mean, if I was in France, I'd probably love the baker a lot. And they got nice bread, don't they? Anyway,
yeah, there you go.
Welcome to this podcast about language and pronunciation. Sponsored by Sharesight.
Should we go straight into it?
Yeah, all right, let's get stuck into it before we lose everybody.
So today's episode is sponsored by Sharesight. So Sharesight is an application that I've personally been using over the past few years in order to track the performance of my stock portfolio. And it's really fantastic for keeping track of things such as your capital gains, dividends. If you have dividend reinvestment plans, then it will do all of those calculations for you. Currency gains, if you are buying shares internationally or you hold foreign currencies. And then the main reason why I use it is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out things such as your capital gains, your dividend income, and more. And you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. And if you use that link, you can also get 4 months free when you sign up to a yearly subscription. And they also have a free plan. So you can go try it out for free for as long as you want. And if you sign up to a paid plan, 4 months free. It's a great deal. Go check it out.
Just to continue getting all of this talk about non-finance related stuff done at the start, I got this new chair because, man, my back has just been shot the last few months working because I've just been working at this desk for so long. I got this new chair, right? And it's supposed to be a fancy one, good for your back, but it's got these different tilt features, how far you can lean back in it. So I can have it on lean back, nothing, medium, or a lot. I can really go a long way back. But I tell you what, I just forget that I've left it on the lean a long way back. And the chair can't tip. It's well designed. So even if I'm leaning fully back, it won't tip me over.
Yeah.
But man, it goes a long way. And it's just so much so that I haven't gotten used to it yet. So when I lean back, it's just far enough that it strikes the fear of God into your heart when you lean all the way back.
Gives you that
it
jerk.
Feels feels like you've just gone. You know that feeling? It's just like
you just like jerk, like as if you're gonna fall. Yeah,
and then it bottoms out, and I'm like, oh yeah, I remember it can't actually tip itself. It can't go that far back.
That's hilarious.
Holy moly, man, my back might feel better, but my heart feels a lot worse now.
Oh dear, I need to get a new chair. That's something I've been looking to do over the past couple of weeks as well. Need to get a really good chair. I spend too much time at a desk to not spend a good chunk of money on.
I got a sit-stand desk as well, that's
really good. Yeah,
yeah.
That's something I was also interested in doing at some point.
I can just literally push a button and it'll just rise, and I can just stand up.
Yeah.
So, yeah, it's good. It remembers exactly where it needs to be, so I can just stand up, and I know it's going to be perfect for my setup. It's really good. Yeah, I definitely recommend the stand-up desk. But anyway, I guess we're just talking about so much other crap because there's really not much finance news this week.
It was a bit of a slow news week. We've got a couple of things to talk about. Some general market news that we'll probably start off with, just because it's probably what everyone's thinking about this week in terms of the market movements. And then
it's a bit volatile this week, wasn't it?
Yeah, exactly. And we've got a few Q&A questions, so stick around to the end and we'll be answering as many of those as possible. But yeah, I guess we'll start off by just talking about the broad stock market news. So yeah, I mean, the US stock market, and I'm not really sure if the Australian did as well, but the US stock market saw its first significant downward movement since March. So really, I mean, if you look at the US stock market, there was that big decline that we saw throughout March, which was I think it was about 37% or something,
35,
right? It was,
37, something like that.
Yeah, it was quite significant. And then since then, it's really just been straight up, which is kind of crazy to think about, right?
Bonkers.
Because it's not as if the economy in the US has just been a straight up improvement since March. In many ways, it's kind of, I guess, it's stagnated a little bit, or maybe even gotten a little bit worse than it was back in March. It's certainly not this straight upward recovery.
Rebound. Yeah.
Yeah. So it's been a strange market, but this week we saw a bit of volatility come back.
Dropped a fair bit, didn't it, at one point?
Yeah, so
S&P.
Yeah,
I'm having a look.
I was having a look at the market this week. So from its where it peaked out a few days ago, I think it was about 5 days ago, to yesterday, it was down 7%. And it looks like that's kind of that downward trend is being driven by the technology companies that are listed on the NASDAQ, because the NASDAQ during that period was down 10%. Right. So I think that was over a 4-day period, which is significant, right? A 10% drop in 4 days is fast. So a lot of people were sort of panicking about that. And basically yesterday, or last night for us at least, the markets rebounded significantly. So kind of just stopped that. But I guess we'll see what happens.
But yeah, I think that I was just checking the Australian market as well. It's not down as much. It's only down 3%, 3.5%. But I think the takeaway from this is, if you're an investor in maybe buying into the American companies, you can't expect this surge to continue forever. I mean, that's just a reality. I mean, with a Schiller PE of whatever we're up to now, 31 or whatever it is, and a lot of these tech companies, I think Tesla had a PE, for example, of 1,000. Which is pretty insane. But I think just you can't expect these companies to just keep running up and getting more overvalued forever. I mean, there's got to be a limit to how much you're willing to pay.
Absolutely. I mean, there's a certain point at which the business actually needs to produce what you're expecting. I spoke about that a little bit in one of my videos that I made this week. I was talking about, did a bit of a case study looking into Microsoft and how Microsoft stock it peaked out significantly in 2000 or 1999. And then it was basically flat for 16 years, or it was negative for 16 years. If you just look at the stock price, excluding dividends, of course. But in terms of the stock price, I think back in 1999, I mean, the business itself was not like many of the other internet companies that were not profitable. It was making a lot of money. It was making about $8 billion in profit a year or something like that. So it was a big company making a lot of money. It was just priced really high. It had a price to earnings of 60 or something, which is really hard to justify no matter what kind of growth the company produces. And that was just an interesting case study because the stock went down so significantly over a 10, 15-year period. But the business itself never really saw any years where its earnings declined. It continued to grow.
Right.
It didn't stop growing. If you look at the business, it was quite a smooth upward trend over its life. It's just that the stock went up significantly and then had to come back down to reality, which is an interesting kind of case study, I think. And I think it's certainly something that could happen to many businesses at the moment. Because Microsoft, as I said, it wasn't a business that was not profitable. It wasn't like a Yahoo, for example, which had a $100 billion market cap and they were, I don't know, they had like $2 billion in revenue and weren't profitable. That's just insanity, obviously. But the Microsoft story, it wasn't quite insanity, I don't think. It was a business that was, 60 times earnings, quite overvalued, but producing a lot of profit, $1 billion company.
So it got really overvalued, then it tanked with the .com crash. Then how many years did you say it took to come back to where it was before?
Yeah, so in 1999 was where it peaked out. It dropped 60% over the next 2 years. That was the .com bubble. Then it's sort of stayed pretty low and then recovered a little bit, but then came the GFC, the global financial crisis. And at that point, if we look from 1999 to 2009, it was down 70%. So it just continued to get worse.
Oh.
And then in 2016, it past its 1999 level. But during that period, it was paying significant dividends to shareholders. So I actually don't know.
So you would have made your money back sooner.
I don't know when it would have been, maybe 2009 or 10. Yeah.
I'm just looking at that chart now. Yeah, you're right. The .com bubble and it crashes, GFC and it crashes. And you're right. 2016 is where it's about level. That's insane.
Yeah. And I mean, the crazy thing is between 1999 and 2016, their revenue went from about $20 billion to $90 billion, which, and if you look at each year through that process, there's only a couple of years where they drop a little bit. Most of it's just up, 10% growth, 15% growth. It's quite significant. So it's just a fantastic case study of what can happen to a business. The business doesn't have to falter for its stock to come down. It could just be that the stock's gone too far. And we might see that happen with something like an Amazon or a Netflix or whatever company it is. But I thought it would be an appropriate time to look at that because of kind of what's been happening. I mean, throughout this year, it's just been insane how expensive. Even the likes of Facebook and Google, for example, I think at some point they were up at 40 times earnings.
Like Amazon's been up at 100,
exactly.
Tesla's up at 1,000. I mean, it's silly.
Exactly. Yeah.
But yeah, you definitely want to watch out for something, it's potentially set up for something like that to happen again. Yeah.
Definitely. Yeah.
So here's an interesting story actually that I had, that I found just because I was desperate and trying to look at stories to chuck in. A cancer diagnostic specialist called Grail today filed for an initial public offering on the NASDAQ. So the startup has raised, this is obviously over in America, the startup has raised almost $2 billion in seed money in 4 rounds of private investing since 2016. In its 2019 round of funding, Grail's valuation was estimated at $3.2 billion. But this is the reason that it caught my attention is because some of the company's notable backers include Jeff Bezos and Bill Gates. So I guess, I don't tend to get too invested or invested at all in IPOs, but I mean, it's probably bodes well if you got the 2 richest people on the planet that are, putting funding towards your company, I suppose.
It's not bad.
But, were you going to say something?
I was just going to say, but how could they possibly be investing in a cancer business? I thought all billionaires were evil.
Yeah, exactly right. They are. They're horrible. No, this company, their technology gives you cancer. And they're going to spread it. They're going to fuck. That's horrible. That's so horrible. No. So a little bit of info on this company. Grail was spun out of the gene sequencing giant called Illumina. Yeah, there you go. Illumina. In its S1 filing, the company wrote, using our platform technology, we've developed a multi-cancer early detection blood test that has demonstrated in clinical studies the ability to detect more than 50 types of cancer across all stages and localize the cancer signal with a high degree of accuracy from a single blood draw. So I find that really interesting. So basically the article reads, as the name reflects, this is like the holy grail for cancer diagnosis. Grail would use ultra deep gene sequencing to look for the characteristic nucleic acids that are shed into the blood by tumors. Those traces are known as circulating tumor DNA. So I find it interesting because, if this technology goes somewhere, then for a lot of different cancers, detection could be as simple as just going and having some blood taken. It's like do a blood test, spin it through the machine, have a look at what's in the blood and check for this circulating tumor DNA. And then that could be a pretty good diagnostic tool for whether you've got cancer. So like at the moment, I guess you only get tested for cancer if you've got, symptoms or blah, 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 or if a doctor suspects. But I mean, if you are imagine if this blood test cost you like $50 and you could just go and check if you had any forms of cancer. Like I'd probably go and do that just on the off chance that I do, early detection and blah, blah, blah.
You could do it like once a year or whatever.
Or something like
just
that.
Have it in some kind of normal routine.
I
I feel like that's definitely the way that these kinds of things are going to go, that rather than there being a cure necessarily to something like this in the near future, it's more going to be that there's better prevention or better detection, and that people are more into a habit of going and getting checked or removing the barriers to going and getting checked for these various diseases and cancers and that sort of thing. It seems like, it's a fascinating technology to be able to get really early diagnostics, really early detection.
So I'm like cheering for this company, just even after looking at what they're trying to do. I'm like, this would be so awesome. And the interesting thing is that this is basically a new market, because I read in this article that no company has approval yet from the Food and Drug Administration to sell a blood test to determine if people have cancer.
Really?
So it doesn't even exist yet. So there you go. So they could potentially be. I think there's a couple of different movers in this space. But I mean, if Grail, funded by Bezos and Gates, can kind of get a first mover advantage and get their product out there, then they could certainly generate some cash.
Yeah, I mean, that's certainly a strong competitive advantage if they're the only company that has approval. Or if they get to that stage. So it's fascinating. Interesting stuff.
Anyway, I just saw that one, so I thought I'd chuck it in. But interesting to kind of see what happens if that actually becomes a thing. But I'm cheering for it. That'd be fantastic. That'd be so good.
Yeah, I mean, it's for me, it's certainly an area that I know not much about, but
I know nothing about it either.
It's fascinating to see how different businesses tackle the problem, because there's obviously some pharmaceutical companies that are trying to develop some kind of cure for a specific type of cancer, for example, something that can actually break it down. And then there's other companies like this company that are more focused on early detection as a means of improving the survival rates out of cancer. So very interesting stuff.
All right, shall we move on?
Yeah, we could. Should we just keep going down the medical news path?
Sure, let's do it. Oh yeah, we'll talk about this next one, about the good old coronavirus.
Yeah, give us.
So interesting news is that Pfizer and BioNTech have moved one step closer to potentially selling doses of their coronavirus vaccine BNT162b2. How do you like that for a name?
Great name.
But they've moved one step closer to selling it to EU member states, which caught me by surprise because I must have missed the news story that they were even considering selling it to the United States.
Right.
So there you go. But it says here, investors have known since mid-July that the duo was in talks with the European Commission, but as governments are apt to do, it's taken a while to get the deal done. The sides have completed exploratory talks and will now enter contract negotiations. They are at the point where they've decided how many doses the contract will cover, 200 million, with an option for another 100 million doses, but haven't determined the cost the EU member states will have to pay. So if they can reach the agreement, Pfizer and BioNTech would begin supplying the vaccine by the end of 2020, subject to an approval by EU regulators. So there you go.
Interesting.
This is interesting, and this news story just made me start thinking, wow, is this legit? Like they've got a coronavirus vaccine? Have I just kind of missed the have I just missed the boat on this? But it sounds very much like they've got a coronavirus vaccine from how the article's written. But then I scroll down and read on, and it says that the BNT 162b2 is currently being tested in phase 2 out of 3 in a clinical trial, which as of Monday has enrolled 25,000 patients of the expected 30,000 patients. However, they haven't actually completed the study yet. So they're waiting for the study results to be available, and they say they could be available as early as October. So I guess what they're doing here is they're saying, look, we think this is going to work. We're testing it now, but let's just, if it does work and it is all it's cracked up to be, let's get the agreements put in place now. I guess that's what they're doing.
Yeah, it seems that way. I think I was doing a bit of reading. There was about 100 different potential coronavirus vaccines that are currently in development, and most of them are in stage 1 or 2. And I think there was I think there's only 3 that are in stage 3, which is the clinical human trials, where they have 30,000, 50,000 people trial it. And I was doing a bit of reading and about the Australian government, because Australian government's made a couple of deals as well with some of these companies to order a bunch of vaccines. And the Australian government was saying that they're going to try, and their timeline for rolling this out was in January of next year. But then there was a number of professionals in this space that were saying that is just ridiculously unrealistic, because apparently for a stage 3 trial to be for a typical stage 3 trial, it usually goes for at least a year. So it seems as, I think the stage 3, and then I got this from Bill Gates as well, from one of his podcasts. He was saying that stage 3 is the most challenging and it's the longest, which kind of makes sense, right? It's kind of the last stage where you're actually testing on humans. So you want to make sure that you're doing a very careful job, because if you don't do a good job, I mean, there's hundreds of millions of people who are probably going to be getting this vaccine. So you want to make sure that you don't make any mistakes. But yeah, it'll be interesting to see how this progresses. I had not been keeping up to date with this news until I read a little bit the last couple of days. The last I had heard was just from what Bill Gates had spoken about, how there was a handful of companies in phase 2. And that, he expected most of them to fail. It's really? Okay. Usually you want to have a substantial number of vaccine options, because most of them fail all 3 stages. So I guess we'll kind of see what happens. But I think there's these 2, Pfizer and BioNTech, and then there's one other company whose name is I can't think of.
I think Johnson & Johnson is in there as well.
Johnson & Johnson had one. I think they're in phase 2. And Moderna or something.
Moderna, that's
something
right.
like that. Yeah. They're in stage 3, I think, as well. So there's a number of things, and I mean, these things move slowly, so it's not as if you have to kind of watch it every single day. And it'll be everywhere as soon as there's a vaccine that passes the 3rd clinical stage. So. Yeah.
Well, it says here, if everything goes well, Pfizer and BioNTech expect to have 100 million doses ready by the end of 2020 and approximately 1.3 billion doses available by the end of 2021.
Right, okay. So,
it's interesting. But having said that, they say that their vaccine would require an initial dose and a booster shot. So the actual number of people who can be treated itself is half of the available doses.
Right. Okay, that makes sense. Yeah.
Also, interesting thing I just had a look at is that they made a deal with the US government to sell 100 million doses at $19.50 per dose. So it looks like it'll cost about $20 for a coronavirus vaccine.
Pretty cheap.
So there you go. Not bad. I mean, if I could get a vaccine and that guaranteed that I wouldn't get the coronavirus or made it extremely unlikely, then I would probably pay $20 for it.
Yeah, as long as it doesn't give me something else.
Yeah, but I mean, that's true. Oh, Gates, he's putting what was the thing?
Microchipping
microchips. Yeah,
needs that data.
Oh God,
I love that. I just love that sort of I guess argument or some conspiracy, because I mean, what possible data are they going to get out of you that they don't already have? Like if they everyone has a phone. Like if there's this big conspiracy for these companies tracking everyone and somehow selling it to someone who uses that information, then they've got everything they need, guys. Like they don't need a vaccine.
Exactly.
They don't need a vaccine.
I think it was something like Douglas Adams. I'm going to butcher this, but a couple of decades ago, I don't even know when he passed away, but he was like, he like predicted the future of people. Like, it's going to be a scary place. People are going to get tracked and monitored, and we're not going to know it's happening, and blah blah blah. And then the reality is in the future that we actually do this willingly.
Yeah, it's voluntary. We enjoy it.
Would you like to turn location on? Yeah, okay. There you go. Now we get tracked and monitored, and we accept. We accept it.
It's funny that, isn't it? It's funny how I guess the change in what we require for privacy compared to like what is convenient for us has kind of shifted over time.
Yeah.
Because I mean that just being able to like letting a random company see your location just for the convenience of being able to get picked up in an Uber or something like that. It's a strange transformation that I'm sure if you asked people that, if you could go back and ask people that 50 years ago, would you give this information now? Would you, to a private company or, hundreds of different private companies? I'm not sure what their answer would be, but it's fascinating.
That's why I get quite frustrated with people that, are always up in arms and saying, they get mad at Facebook saying, oh, you need to respect our privacy and blah, blah, blah. And there's just all these people protesting, we have a right, we need our privacy and blah, 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 blah. And like, I get that. That's fair enough. But I mean, at the end of the day, a lot of these people, they protest that they want their privacy, but then again, they're perfectly happy with sending all God knows what to each other over the internet and messaging their friends and blah, blah, blah. And it's just like, at the end of the day, it's like, well, if you're campaigning that you want this privacy, then at least when you're online, act as though you do want privacy. I mean, read the terms and conditions. If you want privacy, don't have a Facebook account, turn off location, don't allow people to know your location through Snapchat or something like that. It's like,
you don't have to use the app. Like that's the thing that blows my mind. You don't have to use Facebook.
Completely optional.
Like that's their business. Like
it's completely optional. You do not have to engage with their company if you do not wish to do so.
And I mean, it would just be it would be insane to think that you have the right to use a service that costs tens of billions of dollars to run every single year, and you have the right to dictate how they do it. Like, you just don't use it if you don't want to.
Yeah, exactly.
It's their business. Yeah. You don't have to use it. You can use your telephone. You can go back to.
You can go live in a hut in the middle of the flipping mountains and just live off the land and don't talk to anyone and hide in a bomb shelter somewhere if you really want to.
Send a pigeon.
Yeah, exactly. Yeah. Oh gosh.
Yeah.
Anyway, that's my little rant about privacy. Interesting. I actually reckon we're heading to a point in time in the future where privacy will become less and less of a thing. Like, it will just be more naturally accepted that privacy is not what it once was. Like, nobody will really have true privacy, and people will just accept that. The only people that won't accept it are the people that have got something to hide, really, because like the vast majority of people, like, we don't really need. I mean, yes, we need to protect our financial, our bank accounts and blah, blah, blah. And there are some things that do need to be private and not information that's not given out. But for the vast majority, it's just like some people don't want to put photos of themselves on the internet. It's like, I don't care who looks at my face on the internet. Well, obviously, because I run a YouTube channel, but but even just generally, it's just like, well, if some weirdo in Canada sees my face on the internet, like, I don't care. Like, whatever. That doesn't bother me at all, but I don't know.
Yeah, definitely. Yeah.
I wouldn't be surprised if in the future privacy just becomes less and less of an issue, and everyone's just kind of in the same boat, I suppose.
Yeah, I mean, it's certainly already happened. A transformation has certainly happened over the past 20 years with the internet already. So it's only going to continue, I would expect.
Yeah.
All right. Should we talk about this Virgin Australia news? Because this is something that happened.
Oh, yeah. What's happening?
Happened over the past week or 2 weeks, I think. I think I missed it last week. But there was another news story that came out this week. So I can cover both of them for us. But
Why? Thank you.
Yeah, I guess to sort of so the Virgin Australia, we've spoken about them a couple of times on the podcast. They went into voluntary administration, and maybe I'll give a little bit of a refresher on what happened first, and then I can explain the news this week. But so in April, because of the coronavirus shutdown, Virgin Australia, the airline, went into voluntary administration. They basically had debts of $6.8 billion that they couldn't pay. And as a result, they handed the company over voluntarily to administrators to restructure the company and to cover its debts. So basically, they hand it over to this group of people and they look for new money. They look for new owners in order to pay for their debts.
Yeah.
This week, I think it was last week maybe actually, creditors voted on and agreed to a $3.5 billion sale to the company Bain Capital. So Bain Capital is a US private equity company and they are the new owners of Virgin Australia.
Well, there you go.
So they reached a deal. Yeah. And I guess some of the details out of this deal include, all of the employee entitlements will be paid as a part of that $3.5 billion. So that's $450 million of wages and the sorts that are going to be paid for. And then all $2.3 billion of debt is going to be paid for secured creditors. So basically, Virgin had a combination of secured creditors, which means that a secured creditor is basically someone who has a bond over some of your assets in case you don't pay. So like when you get a loan from the bank, for example, for a house, they're a secured creditor for you because if you don't pay that loan, they're going to take your house, right? So
it's like having collateral, I guess.
They have collateral. That's the word I was looking for. So they had $2.3 billion of that. All of that is covered. So those creditors are good to go. They're getting their $2.3 billion. Cool. But then you have bondholders, which are unsecured creditors. So they hold debt for the company, but they don't have any assets that, back that debt. So out of this deal, some bondholders who did not have the backing of Virgin assets were not happy because they are going to be getting about 9 to 13 cents for every dollar of debt that they were owed.
Ouch.
They were in the minority, which is why they were outvoted by the creditors who probably had a substantial amount more debt in the company and could sort of help make this decision. But a lot of bondholders are going to get hurt, just like the shareholders, in that they're getting 9 to 13% of what they should be getting back.
Sucks.
And obviously they're not getting any interest. They're not making any money. They were probably expecting to make some interest on their debt. Instead, they're losing about 80% or 90% of it. So,
but then again, that's what Ray Dalio says. When times get tough and companies go bust, one of the parts of that process is debt restructuring in some way, where you have to go back and say, look, this is what we agreed to originally, but that's just not going to happen, unfortunately. So we need to restructure this debt. And what he says is that, while it sucks, if you've lent money to someone and they can't give it back to you, his phrase is that you'd much rather have part of something than all of nothing. So I guess that can probably be applied. I guess as a bondholder, you probably like to get something back. Like obviously you'd be very annoyed, but I guess it's better than getting nothing.
Yeah, and I mean it's in this process that a lot of debt is just wiped out, right? So that debt kind of resets, and that happens for a lot of companies at this point that can then sort of get back on their feet a little bit without the burden of all of the debt that they've accrued.
So does this wipe out all of the pre-existing shareholders now? It's just 100% Bain Capital? I don't quite know how it works.
Yeah, so that's my understanding. In the press release, it said that the transfer of shares is expected to happen on the 31st of October. So there was nothing in the press release that said, Bain Capital's getting this percentage of the stock. It just said that Bain Capital is the new owner. So my interpretation of that is that the entire lot of shares are being transferred to them on the 31st of October, which would indicate that existing shareholders lose completely. And that would be my impression, considering that there are bondholders that didn't get all of their money back, and bondholders come before shareholders. So if you know,
right, of course.
The fact that the bondholders are getting 9 to 13 cents of their dollar would indicate to me that shareholders are getting nothing.
Again, zero. Yeah. Well, that's interesting, and that makes me think that I guess Virgin Australia will no longer be called Virgin Australia, because I doubt that Bain Capital will be able to use the Virgin name, considering Virgin they're now no longer going to be associated with it because they got wiped out.
No, I think they will continue to use
Really?
Virgin Australia. Yeah. So, I mean, in that when they're paying that $3.5 billion, they're basically buying all of the assets and the liabilities of the company. And one of those assets is the brand, right? So
Is the name.
It's the name.
Oh, okay.
So, yeah, I would presume they would continue to operate under Virgin Australia.
Okay.
That's typically what's happened with airlines in the past. I mean, American Airlines, for example, has gone bankrupt like 5 times. So
That's interesting.
airlines are a funny one, because every single recession that there is, there's at least a couple of airlines that go bankrupt, but then the name just continues on. Like American Airlines has been around for a very long time. Similar thing to kind of General Motors as well. They went bankrupt in 2008, I believe, during the GFC, and they still operate under their name. Just a new group of shareholders. So
right. Okay.
Yeah.
So okay. I didn't know that. I just would have imagined that because Virgin, the name is Richard Branson's. I guess is that now that Richard Branson wouldn't be involved, that the name would have to cease as well. But I guess you're right that they're buying the business, and part of the business is the brand, and it is the name. So I don't know.
Yeah.
2 months later, Richard Branson sues Virgin Australia for illegal use of his name, his brand name.
Yeah, I don't know how that works.
No, I don't know either. I got no idea.
Yeah, because maybe the main Virgin, the American Virgin company, sold the Virgin Australia brand to the Virgin Australia company. So I would presume
Isn't it British.
British. Sorry, my bad.
I don't know.
No, you're probably right. I'm not sure at all. I just presumed. But yeah.
Anyway.
Yeah, I'm really not sure how that works. But the other news that came out of this, which came out yesterday, was that they announced that they're cutting their Boeing fleet from 85 planes to 56 planes. So 1/3 of their planes are being handed over to creditors and other buyers. So
see you later.
getting off another bunch of debt, and I don't know, maybe generating some cash out of some of their planes. And the company basically said that they're aiming to get their fleet back to 75 planes once demand rises again. So they've cut their fleet, and then they're hoping to get it back up to 75, which isn't even up to where it was previously. And Qantas's Alan Joyce, the CEO of Qantas, chimed in on this and said that he expects the market share of Qantas to rise from 60% as it was pre-COVID to 70% as a result of Virgin's downsizing. So Qantas is obviously happy about everything that's kind of happened, because they're continuing to grow their market share. 70% market share is insane.
It's a lot. That's big.
That's big. Yeah. It's it does raise questions about whether there'll be enough competition in the Australian domestic market if one player has 70%.
I mean, even with Virgin Australia, like, it's pretty much a duopoly with air travel in Australia. It's Virgin, Qantas, really. They're the big players.
Yeah.
And I think I believe that Australia has very high costs of air travel because of it. And also because the fact that Australia is so flippin' enormous, and that the main way we travel, say if you wanted to go from Brisbane to Melbourne, you're probably going to fly. I know certainly if you wanted to go to Sydney to Perth, you're going to fly.
Yeah.
Or Sydney to Adelaide, definitely, you're going to fly. So, I don't know what this is going to mean for, when when air travel's up and running again. Might we see even more expensive flights in Australia? But I hope not. But I mean, Qantas are perfectly positioned. They can basically do whatever the hell they want.
I mean,
based on the factors that I was just talking about. So
yeah, it's just one of those industries where they have really heavy physical costs. And there's a significant cyclicality to the industry. So when there's a decrease in economic activity, when there's a recession, they see a significant decline in the number of flights in their revenue. So it makes it very hard for a small airline to survive. which just kind of creates an environment like you see in most airline markets where there's a couple of major players. Australia, there's two, and even the second largest one couldn't really survive, right? And then you have the US market, they have four major ones, and as I said, amongst those, I think all of them have gone bankrupt at one point or another. So even at that scale, when you control 25% of the market, or as Virgin did, 40% of the market, you can still have a lot of trouble being profitable. It's just one of those industries where there's just you're never going to see a ton of different little airlines competing against each other, or at least I don't think so, unless there's some kind of dramatic change in how these businesses run, which might happen at some point in the future. That happens to industries from time to time, but yeah, I don't know. Do
you reckon that when flights are happening again, do you reckon that Qantas will have their ticket prices cheaper, or do you reckon they'll be more expensive?
They would have to be cheaper, I would expect.
You reckon to try and get people getting back in?
I think that's what. Yeah, I mean that's what I would expect. I would expect if they're going from basically no flights, they would start cheap, see what the demand's like, and as the demand kind of gives them a feel for how much revenue they're going to be able to generate, then they can increase their pricing. But if they just came in strong with higher prices than pre-COVID,
maybe people wouldn't.
Yeah, you would. I mean, considering that a lot of people have lost their jobs, or at the very least, a lot of people are in the mindset now that they need to save rather than spend, compared to 12 months ago, for example, that I would expect that they would be cheaper.
Tell you what. I'm looking forward to 2021. I'm going to get my coronavirus shot for $20, and then I'm going to book some cheap flights, and I'm just going to travel the world.
I'm so keen to just be able to go somewhere, just anywhere.
It's like that case of you don't know what you got till it's gone, right? It's like when I had the ability to travel overseas and go wherever the hell I wanted to, I didn't bother to do it because, but now that it's gone, then I'm like, oh man, I want to go here and I want to go there and I want to go on a holiday here and oh dear. Anyway.
Just to book a house and go to the beach. That's all I want for like a couple of days.
That'd be nice. Yeah, you got it worse than I do. You got it much, much worse than I do. But
did you see the new our restrictions for the next couple of months? Have you seen the?
No. What do you have to do?
It's not good. I mean,
stay in your bedroom. Don't come out.
Yeah, exactly. You're limited to
hide under your bed. Yeah. Don't breathe.
Yeah, exactly. Limited to one room in the house. No, no, but so they brought out a plan, and they basically, I don't know the details of it. I didn't really look. But we're going to be in pretty heavy restrictions till the end of October. Right. And then by the end of November, we're starting to get back to normal. But so we're talking about the start of December where you can just have like people over, a decent amount of people over, which is a long time.
That's so rough. That's got to take a toll on people's mental health. Like seriously. Yeah. Like a lot of people will be totally fine. But a lot of people that are like borderline with their mental health, that's gonna be so rough.
It has been tough. I've never considered myself someone who, has, any kind of mental problems or anything like that. But it's been challenging to just stay at home and just do the same thing every single day. It's challenging.
It's draining. Yeah, it pulls you down. But fingers crossed. Come on, Victoria. Yeah. You can do it.
We can do it.
You can do it.
Oh, dear.
Make COVID be the name of the virus, not the acronym for, what is it? I can't even remember now. Oh, damn it. I can't remember what the acronym was. Something about something Victorians ignoring direction. Cases of Victorians ignoring directions or something like that. Yeah. Anyway, come on, Victoria. You can do it. I'm rooting for you. Let's go.
We got this.
Stay at home. Brush your teeth.
Brush your teeth.
That's gonna be the new signs. It's not gonna be wash your hands. It's gonna be brush your teeth.
Brush your teeth.
Anyway, Q&A time. I think.
Yeah, let's do it.
Get stuck into it.
All right.
Oh dear. All right. Let's get stuck into this one. Is there ever a good reason to average up in the price of an equity holding? Yeah. So instead of averaging down, as the share price gets cheaper, you buy more. Is it a good approach ever to average up, buy more as it's getting more expensive?
Yeah, that's an interesting question. I mean, the way I see it is if the stock offers a good long-term return at the price that the market's offering you, then you should buy more of it if you have money to invest in it. To me, it doesn't really matter what direction the stock market is moving. What really matters is like what the price the market is offering you. So in the case of where a stock is falling, if the market, you check the market price and it's at a price where you think you can get a good return, you're happy, you've got your margin of safety and your return, and you invest, and then the stock falls further. It's not the fact that the stock has fallen that you want to add more. It's the fact that the price is still under the price that you can get a good return at, and that it's even offering you a better deal is the reason that you would want to invest. So, that's kind of my view. I think that if it's still at a price where you can make a substantial return and you've got your margin of safety and you've got money to invest, then it makes sense to increase the total value of that investment, even though your average price will go up. If you can increase the overall value and you're still getting it at a good deal, then it makes sense. Yeah.
Yeah. It's like if I had $5,000 to invest 1 month and I've got this opportunity that's at a good price, then I'd take it. But if I saved up some more money in the next month and then it's more expensive, but it still offers a good return and it's still at its kind of margin of safety, then I'll still invest in it for sure.
Yeah.
Generally speaking, I want money in the market. Like I'm not going to go, oh no, I'm not going to buy more because, now instead of, I've modeled things out, instead of getting, 15% returns every year for the next 10 years, it's only looking like I'm going to get 9. It's like, oh, whatever. Like that's still good. I'll still take that deal,
Yeah, definitely.
Yeah.
All right.
But anyway. What's the next one?
I'll ask this question to you.
Sure.
Hey lads, this is a bit of a long one.
All right.
Hey lads, I've been digging into Phil Town's checklist, and on that list, one of the items is the company being 1 or 2 in its industry in free cash flow. Do you guys think using a ratio such as free cash flow yield per share would be beneficial for this point, as companies vary in size? Or is there another metric that I could use to compare free cash flow for companies that I am evaluating? Keen to hear what you have to say. Thanks.
Yeah, I guess so. I guess that would be a good kind of measure, free cash flow per share. Because that would help you compare, company to company. So I don't know. I imagine so. Am I missing something? I'm trying to think of what could influence that. But no, I think so. What do you reckon?
Yeah, I mean, I don't know about that rule actually specifically in terms of, I guess, in terms of finding the number 1 or 2 business in an industry that has the most free cash flow. Yeah, I mean, that the way I go about it is...
It's certainly a number we like to look at,
Free cash flow is, certainly, yeah. And I mean, when we're talking about figuring out what price to pay, we're certainly thinking about how much free cash flow the business can produce for us. In terms of, I kind of go about it in that way, in that I'm looking for a business that's usually one of the leaders in the industry. I mean, and that's kind of the nature of looking for businesses with competitive advantages, is that if a business has a really powerful competitive advantage, it will usually be demonstrated in their growth that then drives them to be one of the leaders in that industry, or at least having one of the stronger financial positions in the industry, or the strongest growth in that industry. So, yeah, I mean, in terms of what metrics I use, I look at the 4 key areas over time as growth, for looking at competitive advantages, for identifying which businesses you would want to invest in. And then in terms of figuring out what price to pay, you can look at that free cash flow yield to compare the price to its cash flows. Yeah.
Yeah, the only thing that I would, because free cash flow is operating cash flow minus capex, right?
Mm-hmm.
So the only thing that I would just watch out for, if you're trying to do like free cash flow per share and you're trying to compare like 10, 15 different companies, is to maybe just consider that, a company could have lower free cash flow one year because they actually decided to turn around and sink a fair amount of money into doing some sort of expansion, which, could be really, really good for you as a shareholder in the long term. But it might mean that their free cash flow for that year was down a bit lower. So.
Definitely. All right.
Yeah. All right, let's head on to this one. This one's been sitting here for a while, but I think it's been sitting here for a while just because we don't really have much to add on it.
Maybe we can answer both of these questions together. We can kind of combine them.
It's basically, the question is basically, how do you choose a good super provider, a good super fund? That's basically the question. So, Hamish, what do you think when you think about super? What are some things that you look for?
I'll read the extent of my notes here. Low fees.
Done.
In terms of super, I'm not the right person to ask for this just because it's not where I focus. I don't even have that much money in super because most of it's in my company. So I don't have that much money in super, so I don't really focus that much on it. But in terms of looking at those investments, low fees is super important. Most super funds have outrageous fees, and it's really hard to find ones that have really low management fees. So having a focus on that. And then, if you're looking for someone else to do the management for you and you're not going to be picking investments, then you want to probably get as much diversity as possible, right? Diversity in terms of country. So having investments in Australia, the US, developed markets, Europe, and then a number of different asset classes as well, stocks, bonds, property. But that's typically what you see, in most super funds anyway. They'll be highly diversified. They'll be global funds. It's really just down to the major difference is going to be the fees, honestly. That's basically my view on that.
For me, it's just like, well, when I look at super, like I'm not very focused on super because it used to be good and now it's just like, well, if you just focus on super your whole life and you retire, you're probably not even going to get you through your retirement on super alone. So I don't really focus on it that much. But super, you have to, it's just part of life. You have to put your money away into super and then it gets invested and then eventually you come back and you can start spending that money. So it's a deal that you're locked into. So, what you said, you have to try and find somewhere that's got low fees. And I always go back to what Warren Buffett says and how, the majority of big fund managers just cannot beat the market. So even if I'm, super funds, they've got asset managers, they're picking stocks and creating, what are we going to put in this high growth? What are we going to put in balanced? What are we going to put in, real estate options, blah, blah, blah. But at the end of the day, I don't really want them. I wish I could just get rid of all those asset managers. I wish I could just call up the super company and say, hey, can you please fire all of your asset managers? Can you please use that money and keep your fees lower? Okay. And can you just sink all of that money into various market tracking ETFs of the world's major economies? And I could basically guarantee you across, a 50-year time period, doing that would make investors more money than, giving the money to asset managers. But that's just the system. The super companies, they want to make as much money as possible off of you. Like they're not really on your side, super companies. They want your money that the government is forcing you to put into their super. So they're going to put their fees up and have these big asset managers say, we do something very important. Our managers look over all these investments and we only make the best choices. But at the end of the day, they just want your money. So look for low fees and just look for any options in your super fund where you can just have it as passive as possible. Hashtag not financial advice.
You know what one of my pet peeves is? Whenever you see a super fund run an ad on TV and they'll be like, we got this return over the last 3 years. And it's like, who cares about the last 3 years? Show me your last 50 years.
Yeah. And it's kind of like as well.
Am I investing my money with you for the next 3 years? No, I'm investing it for the rest of my life. Like, show me your 10-year return. Show me your 20-year return and compare it to the S&P 500 or a global index. And then you don't have an ad.
I love it how they don't even compare it to the market. No. They just say, here at Australian Super over the past 10 years, we've generated annual compound returns of 9%. And then it's like, oh, hang on. So the broader market has returned annual returns of about 15%. So you guys are actually underperforming by this large percentage. But no, they don't say that. Here at Australian Super, we care about your retirement. We also care about getting filthy rich.
Oh, dear. Anyway. yeah, I mean, it's one of those weird industries. Like, why do they make money if like they still make their fee if the portfolio goes down 1 year? Like, why?
Yeah.
Like, why do you still make money? Like,
Yeah, I know. It's annoying. But I mean, it's just the way it's going to be.
Yeah.
I mean, it's like an arbitrage. I mean, if the government says we, by law, have to have 10% tucked away into super, then super companies are licking their lips and going, "Oh, here we go. How much of this 10% can we keep for ourselves?" But anyway.
Oh, dear.
All right. Should we wrap things up there?
Yeah, we'll wrap things up there for today. Thanks everyone for tuning in. As always, if you have any questions that you want to ask for next week's episode, then head over to the YouTube version of the podcast and just click on the latest podcast there, and leave your questions down there, and we'll grab as many as possible and chuck them in next week's podcast. And you can go directly to the podcast on YouTube at youtube.com/The Young Investors Podcast. So go check that out if you're interested. Also, if you just have any topics or news stories that you see throughout the week, that also helps us out.
Help us.
Particularly when there's not a whole lot of, I guess, broad news going on, or big company news. If there's something specific that you want us to cover, then feel free to let us know. Thanks to Sharesight, as always, for sponsoring today's episode. Sharesight.com/young investors if you want to get 4 months free. And thanks, Brandon, for joining us as always.
Woohoo. Done like a dinner. Thanks, Hamish. And we'll see you guys next week.